In this segment, we're going to talk about mining. And mining is different to oil and gas, which we talked about in the last segment. In the 70s and 80s, many oil and gas companies, major companies, diversified into mining on the assumption that it was the same geology, different sort of geology, long-term capital intensive, resource-based. But there are fundamental differences, and all the majors sold their mining ventures in the late 90s or early 2000s. Hydrocarbon production involves just three fluids: oil, gas, and water. Mining is different. The minerals are embedded in a matrix, and to produce it, you have to take the matrix out as well. That's not so in oil. In oil, the only waste is some co-produced water. And that's true even for things like alluvial diamonds. The ore bodies are complex and irregular shaped. They don't follow fixed patterns. They come and go and are patchy. Ore removal very often requires open pit development, digging out huge volumes of rock, and it produces large amounts of waste rock. And then you have to actually smelt or chemically treat the body in order to extract the metal. So it's a very different kind of business. The concentrations of the ore vary also by orders of magnitude. Products mined vary enormously in value and in their distribution in the Earth's crust and in the ore that is mined. Precious metals are measured in parts per million of ore. Base metals, copper, lead, nickel, zinc, are probably in single-digit parts per hundred and priced in hundreds of dollars per ton. Iron ore and coal may be in quite high concentrations, a few percent, and are priced in tens of dollars per ton. And quarried rock for construction is also tens of or hundreds of dollars per ton. The location and transport logistics only make a difference in the bulk commodities. Mining company strategies vary. Each major company will speak of their own unique strategies, but in fact there is obviously often a great deal in common. Most strategies focus on at least 3 and probably not more than 5 minerals or metals. That's partly based on history. So an Anglo-American has a strong position in platinum in South Africa, and BHP Billiton has a position strong in iron ore. The positions of having positions in different minerals reduces volatility because they operate on different cycles. So diamonds are on a luxury goods cycle, while copper is on an industrial metal cycle. And if you have both in a single company, you smooth out the earnings. Companies in their strategies also take into account the future demand-supply balance. So in gold, for example, there is very limited future supply. New gold deposits are rare, but the market is not growing. In copper, there is relatively available copper, but the market is growing. So in your strategy, you probably pick a mineral which suits your history, suits your technology, but also which perhaps has a price history which is attractive. And I have to admit that many of the more concentrated industries have more promising price histories. This is strange given the strong anti-competitive regulations in the market, but the fact remains that that's so. Anglo-American, for example, spent a long time trying to get into iron ore, which was a market dominated by 3 big producers: Rio, BHP Billiton, and Vale of Brazil, and eventually succeeded just when the price went down. Most of the major mining companies are now divesting themselves of their thermal coal for reasons, and sticking to metallurgical coal for reasons of the future of coal in climate. Such portfolio strategies, I think, as I said, can be quite long-term. Once you've chosen your portfolio, then you work through the portfolio according to the cost curve. You try and make sure that every one of your mines is in the lower quartile or second lowest quartile of the mining cost curve. What do we mean by a mining cost curve? If you take, for a given metal, say copper, every mine in the world and plot on the vertical axis the cost of production of that mine, and on the horizontal axis the volume, you build a picture of the world's production going from low, up to high. Another major difference between mining and oil and gas is that the price is very often quite close to the upper end of the cost curve. There is, in oil and gas, historically, due to the activity of OPEC, there was a lot of rent in there. So governments took a big take. So the production cost, the amount that you spent on actually producing oil when you had made your investment, was relatively insignificant. In mining, that production cost, the operating cost, is often very high. So when the price goes down, the mines at the top of the cost curve begin to shut in. They don't close permanently, but they shut down to save operating costs and mothball themselves. And every time that happens, perhaps the first 15–20% of the cost curve closes in, and then the price goes up again, and you enter another cycle. Mining is also different in a number of ways. There are very few state mining companies. There's Codelco in Chile and Vale in Brazil, although Vale is now partly a private company. China has state mining companies such as Minmetals, but their objective is basically to acquire metals from overseas. There is no producer cartel like OPEC, although, as I've said, in iron ore, there are 3 big producers who are sometimes suspected of being cartel-like. I don't think that's true. Many Middle Eastern fields are profitable pre-tax with oil prices in the teens. With many metals, the break-even price is not far above the upper part of the cost curve. Mining companies in general do not run trading divisions. This is, I think, because there is less integration from the upstream in mining to the consumption. Most miners sell their product, metals, into other people's supply chains. So they didn't need trading. But nonetheless, there are traders, the same traders, Glencore, for example, who have begun to link from production into trading. The exception to all of this, I think, would be a company like ArcelorMittal, which started as a steel company but has as an objective to be involved in the mining of iron ore for at least half of its production. Lastly, I think we have to talk about commodity cycles. Commodity cycles have always been with us. The most recent boom, starting in 2002, after a long period of relatively low prices, was driven by China. And the recent drop in prices has also been driven by China. People forget about these cycles. So when the 2002 cycle started, we reminded ourselves that there were cycles and it was going to go down. But somehow people, after a while, forget it. And they started using phrases like stronger for longer, and then began to invest heavily in new sources on the assumption that Chinese growth would go on forever. There were new moves into new frontiers and new mines. Infrastructure was built or planned in new countries such as Guinea, Sierra Leone, Senegal, Liberia, and so on. Experimentation began in producing from deep-sea deposits. And the long boom, the demand for services led to very severe escalation in costs, which is very difficult to reduce subsequently. And the industry, frankly, competed with itself to return money to shareholders in the form of share buybacks, so buying back their own shares to return money to shareholders. When the prices collapsed, the response has been to cut capital expenditure on new projects, to slash operating costs, and to raise capital through asset sales and mergers and acquisitions through synergies. Plans for mining in new frontiers have largely been shelved. Once the balance is restored, the seeds of the next cycle will commence, and we will begin the cycle game all over again. It's life in mining, full of cycles. Thank you.